Good afternoon. Welcome to the May Crop Report webinar for INTL FC Stone. Certainly plenty to talk about today. This is a rather unusual report. Well, maybe not unusual, but I probably need to get the disclaimer slide up there for now so you can look at that. I know that's something that everyone's waiting to see. This report was full of surprises, some of them bullish, some of them bearish. A very significant report in that it sets the tone for the growing season ahead. The focus of this report is now looking forward to the 2017-2018 marketing year. So while we still have a safrinha corn crop that has a lot of variability potentially in it, most of the Southern Hemisphere production is largely known. And so the focus is now looking forward to the 2017-18 marketing year, and specifically on the U.S. Midwest, but also to some extent other major growing areas around the world as well. Now, looking forward, here again, we want to set the backdrop for this report. Price is a function of supply and demand, but it's modified by the flow of money. As we've talked about in the past, the direction of that money flow and the sentiment toward the commodity sector overall as a backdrop to this crop report certainly shapes the filter through which the funds will look at these numbers and see them. So let's take a look at and see what's happening to money flow. First of all, let's look at the dollar. This is a weekly chart going back to the first quarter of 2010. Note again that we had the strong rally in 2014 on the expectation that we would start monetary tightening at some point. 2015 was kind of a year of, well, is it going to happen or isn't it going to happen? 2016, we started getting that optimism it was going to happen. And in fact, we really accelerated the gains in the dollar post-election on expectations that we would get fiscal stimulus from the new administration and new Congress that would allow the Federal Reserve to pick up the pace of monetary tightening. That has pulled back considerably as we look at particularly here in 2017, where the dollar posted was 13-14 year high and trended lower over the last several months. The question is, where do we go from here? We're kind of at a point now where we tested over the past week some key trendline support. We poked back above it. Now the question is can we take out the resistance? I would say if you look at this chart, it would suggest that over the next month is going to be a telling time. Part of that may come down to whether they see progress on tax and regulatory reform. We've seen a tax bill been proposed. Can it move through Congress? There's been some fears over the last 24 hours that the firing of FBI Director James Comey may create enough of a distraction for Congress to slow down their focus on tax reform. So the dollar is pulling back a little bit today. But overall, I think we're at a pivotal point, and this is going to be key for money flow going forward. Historically, keep in mind there's been a strong indirect relationship. When the dollar is rallying, money flows out of the commodities. When it is sinking, money flows into the commodities. That relationship has broken down to a great extent this year. They've been rallying and sinking together. I do anticipate that at some point we're going to get back to that old relationship. Here's the CRB Index chart I've been showing you. And again, this is one of two commodity indexes that I'm going to show you, the charts. Notice that here on the right, as we look at this chart, here on the right, we see that we're largely in a sideways trading range, but with a recent bearish bias and testing key support off of these 2016 lows. We have bounced off of that support, but can we go back up and test the top? Or are we going to break through that support? Here again, this CRB index is nearly 40% energy. 23% of that is crude oil. So it's heavily weighted to the energy sector. So this will largely be impacted by what happens with crude oil, which is paying attention to what OPEC is going to do. OPEC meets on May 25th. to decide if they're going to extend their agreement to curtail production. They have been reluctant to increase the size of that production reduction, but there are an increasing number of hedge fund traders now who believe that they need to increase it, not just extend it, but to increase it in order to make a significant difference, since shale oil production, as well as oil production in other areas that aren't participating in agreement, is increasing dramatically due to the higher prices that we saw over the last few months. Now, as we look at the continuous commodity index, this is a basket of commodities where they're all equally weighted. And you see there on the right-hand side of the chart that it is actually breaking through that chart support. So it's very vulnerable to another leg down here, and that is the kind of the atmosphere in which this crop report came. Now, coming into today specifically, we saw a weaker dollar, crude oil bouncing because of a favorable inventory report showing a bigger than expected draw on supplies over the past week. And so money flow for today specifically has been a little bit more positive, but these overall trends are still leave us very vulnerable. And I think that's why we had a little bit more of a muted response to today's crop report. And I see I misspelled the word similar, so I'll try to get that corrected. This chart, the blue shaded area, again shows net fund ownership of corn, soybeans, and wheat. The orange line or burnt orange line there is the CRB Index I showed you earlier, and you can see the correlation there is pretty strong as well. Now, from today's report, we see, excuse me, we see here are the South American production estimates. I'm going to look at them again, even though we're starting to focus forward. One last time, I want to look at Argentine production. We'll probably continue to look at Brazil corn production a little bit longer. But the numbers in Argentina came in a little bit better than expected, particularly for the corn crop. We knew they were having a really good growing season there. Soybeans, we were expecting a little bit less because the reports have been that the flooding last month had a little bigger impact on soybeans. USDA pushing that estimate up to 57 million metric tons for beans, 40 for the corn, and so a little bit better than we expected. On the corn, our Brazilian team continues to do, well, corn and soybeans, an outstanding job of pegging this year's crops. It's the second year in a row they've done just an outstanding job. 96 million metric tons for corn, 111.6 million metric tons for soybeans. You see our Brazilian team estimates there at the bottom, 96.15 million metric tons and 111.8 million metric tons. So doing a very fine job once again. USDA beating the trade expectations, and not our team in Brazil. They've done an outstanding job. Looking at the wheat production estimates, this is the first report of the year where the production estimates are based on actual field surveys. So what will they do? You'll notice my numbers there. I expected USDA to have, on the bottom row is my numbers, I expected USDA to have a little bit more friendly bias on the wheat because of the formula they were using, because of the way the wheat looked on May 1st when they were surveying fields. Yes, much of it was covered with snow in the western plains on May 1st, but we saw that overall the sense was from the wheat quality tour, of which NASA representatives were on, was that the wheat underneath of the snow, you just couldn't tell. So they were going off of the rest of the wheat. And so apparently NASA here, not seeing quite as an optimistic of a picture. There is still a sense, because of the formula that they use in calculating these yields, which give, I think, too strong of a bias to the upside because of the inclusion of last year's tremendous yields, and because we're seeing continued deteriorating conditions in the western plains and in the Midwest, where the heavy rains were. At the same time, the West is getting snows. These very well may be the highest production numbers we see. So bottom line is, we don't have hard red spring data yet. We don't have Durham data yet. Those crops are being planted. I think one of the keys is going to be, will those hard red spring acres drop? I do believe that they will. I think USDA will make a downward adjustment on June 30th, but we'll talk about that here a little bit later. Looking at 2017-18 ending stocks. First of all, wheat, USDA pegged at 914 million bushels. Now I have down here a trade estimate of 1.014 billion bushels. I got that from Reuters survey, but it apparently after I got that off the Reuters survey, they must have had a correction, and I'm now seeing the numbers for the average trade guess being closer to 934 million bushels, I believe is the number I saw. My estimate was at 926 million bushels. And I think the problem there, if you look at the highest trade guess, was at 2.320, so that raised the average. As I look back at the numbers, that looks like somebody copied over a corn number on their estimate, and that threw off the average. So 934 was actually the average trade estimate, if my memory is correct. It's still a little bit better than expected, but not all that much. Corn, very much the way it's expected, 2.1 billion. Both of these being a couple hundred million bushels off of what we saw last year, or for the current year. So this is looking to the next year. Soybeans, 480 million. That's up about 50 million from the current year, but that is much less of an increase than anticipated. Most in the trade expected a number with a 5 at the beginning, a few even looking at a possible 6 at the beginning of that number. I do think that, excuse me, I do think that in a departure from their past habits, USDA has overstated demand for U.S. soybeans. As I've looked at the numbers, historically they underestimate export sales, U.S. export sales in this initial May report, about 80–82% of the time over the last 21 years. And I think this year they may have finally tried to compensate for that, may have overstated it. Even the crush number, I think, is a little bit above capacity in what the industry is able to get through the processors. We'll talk about that a little bit more as we go. Global ending stocks. Okay, soybeans, pretty close to expectations, and pretty close to last year. Not a big change, down a little bit from last year, just a little bit above what the trade was expected, and certainly above what I was. But the big picture scheme, that's pretty small. So no real surprise there. Corn, huge surprise to the bullish side, 195.27 million metric tons. Trade expecting 209.72. I was at 205.93. That 195.27 was just above the lowest trade guess. Look at that, the lowest trade, or excuse me, the range of trade guesses was nearly 35 million metric tons. USDA coming near the bottom side of that. So that was pretty significant surprise. Overall, though, when you look at this, this is basically about a 31 million metric ton drop from the current year. So looking at next year's corn ending stocks, 20 of those 31 million metric tons come from China. USDA is looking for a big drop in Chinese stocks. They're still big. They've been nearly half of the world's surplus corn in China. That is changing now somewhat. It's still a big surplus, but USDA thinks they'll make a lot of progress over the coming year. And so that accounted for a lot of it. Now, that's significant because those big stocks have weighed on the world prices, but keep in mind that China is basically absent from the world market. So that's not as big a market impact as what you may think. It does provide some encouragement that we're turning the corner, and maybe once China works through their big surpluses, they'll return to be a corn importer. Maybe this reduces the risk of them being a significant corn exporter, but most of that decrease comes from China. On the other side, wheat, 258.29 million metric tons, coming in, what, about 12 million metric tons above what the trade expected, about 14.5 million metric tons above what I expected. Here again, China was the big factor. When you break it down, we saw a big increase in Chinese stocks. And in fact, if you remove China from the equation, global stocks would have come in about 13 or 14 million metric tons lower. That's how big of an impact China had on this number. Looking at, looking at these corn numbers now, we see that domestic stocks are declining slightly, still at a relatively high level from a historical standpoint, but we're heading in the right direction. The blue bars in this graphic show global corn stocks in terms of days of use. So we're looking at global corn stocks down to about a 64-day supply. If you remove the United States and China, it's at about a 42-day supply. So quite a difference there. Removing U.S. and China, we're really in just-in-time supplies here. Not a big surplus, but the stocks in the U.S. and China do matter to the markets, especially what's the United States, and we are starting to work those lower. Soybean stocks. Well, first of all, look at demand. As we look at Chinese demand, the dark blue bars, you see the somewhat parabolic growth there. And it seems like every year when USDA adds another line of data, on the right-hand side, we fall short of that parabolic trend line. And then by the time we finish the marketing year, we're at or above it. USDA just has a huge, tendency to understate this demand. I made a comment earlier. I felt like USDA was overstating demand this year. Let me clarify. That's for domestic export demand. When I look at global demand for soybeans, I still think that they're being on the conservative side, and we'll see the number go higher. I just think that more of it will come from our competitors than from the United States, but we'll see. Here again, the lighter colored bar is Chinese imports, and I do expect that to rise with the overall demand bar as we go through the marketing year. Here's USDA's tendency over the last 21 years, looking at final soybean exports relative to USDA's initial May crop report estimate. You can see the tendency for exports to come in well above what USDA projects. Most of those exceptions, not all, most of those exceptions, and there's 6 of them there in the last 21 years, was when the crop fell short, and so we simply didn't have the soybeans to export. Looking at ending stocks, I love this chart. It shows one of the most significant tendencies that USDA has, and that is to overstate ending stocks in their initial May crop report of new crop. This is looking at the 2017, well, this would be looking at new crop each year in a May report. 18 of the last 21 years, they've done so by an average of 141 million bushels. The trade knows this, and that's what they're trading, and that's why we got an initial buy in today's numbers, although soybeans weren't able to hold that. In that light, let's take a look now at summer weather. Overall, we see in the top left-hand corner here, oops, there we go, sorry about that. We see this chart in the top left-hand side is an accumulation of the various models forecasting the ENSO cycle. That would be the El Nino La Nina cycle. If we then look at this June, July, August line here and get about midpoint, it suggests that we should be in a weak El Nino. A weak El Nino would be a 0.5 to a 1.0 degree positive aberration, that's Celsius, in sea surface temperatures in the Nino 3.4 area of the equatorial Pacific. We did think at one point that it would be more of a weak to moderate strength El Nino. Now the sense is that it's going to be more of a neutral to weak. And if you look down then at the lower left-hand chart in the June-July period, we see, what is this, about 64% odds now will be in an El Nino, about 35 to 36% odds that will be in a neutral phase. during the June, July, August time period. Since we're in a relatively weak El Nino phase, that means that other factors, it's not a dominant driver of the weather. Other factors can be at play as well. And so we look at what those other factors are, and one of them is this area of the northern Pacific. And right now it is kind of on a little bit on the cool side. So we'll watch that. Another, and down here, this is the ENSO area, the ENSO 3.4 area, or Nino 3.4 area. That's a little above warm temperatures, above normal temperatures. And then the other area is this area, and we're starting to storm here, so a little bit of a distraction as a strong storm moves here into the Kansas City area. We have some real warm temperatures off the west coast, and specifically off the Baja of California. So when we see these weak El Nino conditions, and first of all, let me say that our partners at Commodity Weather Group have indicated, as they've looked back all the years to 1950, they don't find a single year that is identical to this one in the setup. But they do find a number of years that have a lot of similarities. And so that's what we'll take a look at, is those years with similarities. But while that makes a challenge for forecasting, probably one of the overriding factors we find is when you have warm waters off the Baja of California, it's extremely rare to see a hot, dry summer in the Midwest. And when you have those warm waters off the Baja of California, you almost always have more mild, wetter conditions in the Midwest that favor above trend yields. So will the water stay warm? Right now the model suggests that they will stay warm. We don't see any indications of that changing. So let's take a look then. The other factor is this strong jet stream, Pacific jet stream coming in, bringing moisture into the Midwest, over the mountains of the Midwest. Now, back in 1988 and 2012, we had a strong jet as well. But the makeup of sea surface temperatures in the Pacific was different, such that it caused more buckling in that jet stream, allowing a high pressure ridge, a dome of doom, to form over the Midwest. This year we have these more warm temperatures over most areas of the Pacific. Let me go back. I got a little anxious there with my clicker. There we go. And so forecasters do not expect as much buckling of the jet stream, maybe a little bit over the eastern Midwest, but a very active jet stream. Why is that significant? When you put all these factors into play, that makes 1993 one of the analog years of significance. Forecasters currently do not expect the same intensity of jet stream and therefore the same intensity of Midwest rains as we had in 1993, but they do see some risk in it. Now, when you put all the analog years together, they come up with these graphics. This is the analog years from 1950 forward, and we see from that 29% of the years, that is up 3 points from last week, we had a hot, dry summer. So that's up 3 points, but it's still just 29%. 71% of the time, we had more favorable conditions. 8% of the time, we had a warm but wet summer in the Midwest. 19% of the time, we had a dry but cool Midwest. 44% of the time, we had a cool and wet Midwest. So that's what the odds favor at this point. Now, they took a look. They didn't have data points going back to 1950 on the yields, but they did from 1980 forward. And so they took a look, and that's what I've circled in red, is from those 1950 forward years. They took those years and looked at what yields did for corn and soybeans in those years relative to trend. And sure enough, we saw that above trend yields were seen in those years at 71% of the years, and in the cool wet years it was 7% above trend for corn, 7% above trend would top last year's yield. And if we're 3.6% above on soybeans, we'd be getting close, not quite last year's yield. So a big impact, but on bigger acres for soybeans. Here again is the potential detours we could see in this forecast. On the left, you see the warmer, very wet route, aka 1993, which we'll be watching. And the forecasters at Commodity Weather Group said that is a moderate risk and something we have to watch. And I know there's certainly some people in the southern Midwest saying they've already seen worse flooding than 1993. But then again, as you can see from that graphic, in 1993, the heavy rains were more focused to further north and west than they've been so far this year. The other risk is the hotter, drier route, which we saw in 02 play out. And right now, forecasters put a very low risk on that. So let's put it all together now. We have the crop report. We have the weather outlook. So let's assume here, let's make some assumptions of where we go from here. You've seen USDA's numbers. What are my numbers? In the first column there, I'm looking at 170 bushel yield. Yes, I think USDA's trend is too high from a trend studying standpoint. I think it's overly biased by last year. 170 bushels per acre on USDA's 89.996 million acres. That gives us ending stocks of 2.1 billion bushels, very close to where USDA came out. My numbers come about a little bit different. USDA actually has a reduction in feed usage for next year, even though we're anticipating continued expansion of the poultry and the pork, and I think some modest expansion of the beef industry as well. I think that says how vulnerable we are to seeing this year's feed usage number drop yet before the end of the marketing year. Now, what if we have a repeat of last year's yield? We have that cool, wet summer and a repeat of last year's yield, and we're able to make good progress this week after the current system moves through, and we get 91.6 million acres. I have a little less confidence in that now than what I did a week ago, but 91.6 is still a possibility, but it may be a stretch. Anyway, that gives us stocks of 2.476 billion bushels. Probably that's a little less likely, as I said. Probably should pull that acreage back a little bit, be closer to 2.35 to 2.4 billion bushels. Not that much different than where we're at right now for the current marketing year. And so therefore, price not that much different, although if we repeat that 2 years in a row, we're going to start eroding price in all likelihood. On the other hand, what if we don't get it all planted? And that's a little bit more of a possibility now with the wetness. Today's outlook was quite a bit wetter once again. And we only have a yield of 165 because we had some areas that are just too wet. And it's not hard to get a 165 yield. That's just down 5 bushels from my trend yield. That drops stocks to 1.5 billion bushels. Suddenly we're looking at a marketing year average cash price of $4.50. So while I am not bullish corn, today's report does confirm that we are a little bit more vulnerable to running tight on stocks. And so I think that once the outside markets start to become a little bit more favorable in their sentiment toward the commodity sector, that we will see the market start to build a little bit of that in. Excuse me. And so I am a little bit more optimistic longer term if that plays out. The risk is that if we get that cool, wet summer and we get back-to-back big crops. Soybeans, same type of dynamics here. I'm using 47.5 bushel yield on 89.5 million acres. That's USDA's acreage. I am a little less optimistic on USDA's crush numbers. I think we're too close to capacity to reach that. I am, believe it or not, a little bit less on the exports. I'm always bigger than USDA on the exports, it seems like, and come out to be right. This year, I'm not so sure. I think those exports will fall a little bit below where USDA is currently at. So my ending stocks is at 502 million bushels, a marketing year average cash price of $9.20 per bushel. If we have a repeat of last year's yield and we do get 90 million acres planted, that higher yield on bigger acreage really starts to explode the stocks up above 900 million bushels, marketing year average cash price nearly $1 lower. So pretty bearish. On the other hand, if we don't quite get the acres planted, we don't double crop as much because the price declined, and we pull about 5% off the national average yield, and we come up with 184 million bushel ending stocks, marketing your average cash price is about $3 higher than the bearish scenario at 11.25 per bushel. So going forward, you know, weather does matter at this point. I think that's what the trade's really going to focus on in the soybean market. Let's look at the global wheat picture. I showed you this chart for corn, now for wheat. You notice the blue bars there is global stocks in terms of days of supply. And we're just shy of 128 days supply. If you take out the United States and China, we're closer to about a 64-day supply. Not running out of wheat, but that's getting closer to a hand-to-mouth supply. And so wheat is in an improving position. Today's report looked bearish when you look at those world numbers. But once you take China and U.S. out of the picture, not so much. Now, you can't just take the United States out because we are a significant factor. But the rest of the world is not quite the surplus that it was in. Notice how it is trending lower. And so here again, less bearish than what we've been. When we look at the winter wheat ratings, they are starting to turn lower as we're really starting to see that storms, the snow in the western plains and the rains that we saw in the Midwest starting to take their toll on the crop. As we look at this crop, I saw some comments by Dr. James Schroyer, retired from Kansas State University, been out to look at the wheat. And I think he makes some excellent points, is that wheat was largely laid over. Some of it was stems are snapped, some of it they were kinked, some of it they were bent. Now the natural reaction of the plant, and keep in mind wheat is a weed, and it's going to have its defenses to try to come back, and so it's releasing now hormones, growth hormones, to turn that stem higher to get the head up off the ground and pointing toward the sun. That's fine as long as we have very favorable weather. If we start putting a little bit of stress on that plant with some warmer temperatures and drier air, we could have some premature death of the plant. We could have some shriveled kernels, just not feeling well. So we'll probably see a wide variety there of things affecting this market going forward. And the yield potential we have. Weather is really going to matter in the weeks ahead. The bottom graphic you see there for this week of the year, what the condition index score was for the winter wheat in this week of the year. And you can see that from a historical standpoint, this crop is still pretty good. It is trending lower. And of course, the blue line there is final yield, except for this year, it's estimated yield. But you see that we are trending lower, but yet it's still pretty good. So watch that. When you look at today's data on anticipated harvested wheat acreage, Kansas was down 1 million acres of wheat. They're expected to be down 1.3 million in harvested acres. So it says a little bit something there about what USDA sees happening in abandonment. Nearly everywhere across the country reducing their harvested acres this year. When we look at yields, similar pattern, down significantly, 15 bushels in Kansas, down 8 in Missouri, 6 in Oklahoma, and across the board just about we're being down on our winter wheat yields this year. When we apply this by class to class, and in this case we see the orange bar is the 2017-18 marketing year, and those are my estimates and what I foresee happening, not USDA's, mine. The rest of them are USDA's, that's mine. I do see a little bit of a downward trend here in terms of days of supply for hard red winter and hard red spring, more significantly for hard red spring. I see soft red winter wheat stocks continuing to be burdensome. If you put it all together, and I want to draw attention here now to this column right here, this blue column, 2017-18. The yellowish column is USDA's numbers calling for 914 million bushels, marketing your average cash price at 4.25. I do not estimate marketing your average cash price for wheat because the correlations are just too poor with U.S. fundamentals. But you see my bottom line is 896 million. I'm a little bit more optimistic than is USDA, but that's still a lot of wheat. It is less bearish. It is less bearish to the point where we could see the funds come in and cover their short positions if the environment were to become more conducive for the commodity sector as a whole. There is no reason here, though, to suggest that rationing with higher prices is necessary. Take-home points. Excuse me. Today's report was full of surprises, but the market reaction was rather muted. Corn was higher on the day, but it is still in the sideways trading range that we've seen for the last 6 months. About a 20-cent trading range for the July contract, 360 to 380. We're trading back and forth in that range, and that's what we were doing today. Soybeans, we bounced off a couple days ago. We bounced off the bottom of a channel. It is an ascending channel, grant you. Bounced off that channel. Today we bounced off the top of the channel. It's trading the charts. So we had this report with all of the surprises. It makes the coming year less bearish, but by no means bullish if we have trend yields this year. And in reality, it did very little to really impact the market. Very muted. The focus is now on the summer growing season. Outside money is at a pivotal point. What it does in the coming weeks will probably determine if we go ahead and pull these grain prices out of the doldrums or we push them down another leg lower. Markets do not remain stagnant. They will find a reason to move. They will move. Which direction is largely going to depend on growing season weather, which right now is favorable, but also on money supply. Is it going to flow in? Is it going to flow out? And I think we'll really see that fall into place here over the next month. So with that, I will open it up for questions, and I believe, Jake, you're going to read the questions to me. Is that correct?
Yes, Arlan, can you hear me?
I can hear you.
The first question comes from Francois. Hello, can you please explain why USDA made such a big change to Chinese corn inventories? Were they fake, or is that related to recent auctions? Sorry, I may have missed your explanation.
First of all, I'd like to compliment you, Jake, on pronouncing your name. I think you did better than what I would have, but hopefully we got that right. But on the Chinese stocks, that's always a guessing game with USDA. If you look at the attaché numbers versus what USDA does versus other numbers we get out of China, nobody really knows what China has. It's a guessing game. We certainly don't trust their official numbers. It's generally believed that they have huge stocks of low quality. At USDA, and I did look at kind of the breakdown of USDA numbers, they're expecting a significant increase in feed usage of corn. That's interesting when you look at their hog numbers, their poultry numbers. You could probably make the argument for it. I think they may have gotten a little bit too aggressive there. On the other hand, I am a little bit, I look for a little bit larger drop in production this year, a little bit bigger drop in acreage, and we have been leaning toward expecting some of the corn belt to be dry this year, although that's looking a little bit better today than what it was a week ago. But it really comes down to USDA. They make adjustments in hindsight for 2 or 3 years back for China with frequency. And for whatever reason, they decided to make that a big adjustment. I don't know how much confidence we can really put into it. Thank you.
Arlan, you were correct. It was Francisco, not Francois, so I apologize.
Oh, okay.
The next question comes from Cindy. She has a question but also mentions things to consider of wheat in Kansas. Loss of acres due to poor emergence, then hit with mosaic, then hit with blizzard. Also, much of wheat is being pasteurized by calves. But don't know if this is just western Kansas. Is it Kansas in general?
Excellent questions, and I take it Cindy is in Kansas. And I would add the latter part of that question is we're seeing a lot of that in Oklahoma as well. In fact, we'll probably will see abandonment, which we call it, closer to the 50% range. Very high abandonment in Oklahoma. A lot of grazing out happening there. If you look at the feeder cattle weights, you can tell it. Feeder cattle weights are way above normal this year. Putting the extra weight on the cattle on wheat pasture and then taking them to the feedlot. In Kansas, the problems are significant. She mentioned poor emergence that we had last fall. I personally saw that as well driving across the area. And if you go into a lot of these fields that look good from the road, you look straight down, you can see a lot more space. I'm sure that's nothing new to Cindy. I'm sure she's seen that, but some thinner and more erratic stands. But there's also a lot of good wheat in Kansas, particularly in the central third of the state. There's a lot of good wheat. I think that's most of what has been accounted for in this report. Much of the West, when this report was derived, was under snow cover yet. And even if they did account for some losses, particularly if we put some stress in this crop, I think those losses are going to increase. Keep in mind what I said after the big winter storm. The snow band covered about 40% of Kansas, about 20% of the hard red winter wheat belt. If you assume 50%, I'm pulling a number out of the air because losses will be anywhere from 10% to 100%. If you assume 50% loss in that 20% band, it pulls hard red winter wheat stocks from a 7-month surplus this year to a 4-month surplus in the year ahead. That's a huge drawdown. That's still big stocks. That's the big problem that we face right now. And if, in fact, we see a more acceptable sentiment toward the commodities emerge in the weeks ahead among fund managers, then I think the funds will start trading this more. But as long as they're bearish in the commodities as a whole, these factors are not bullish enough to sustain a rally in the midst of a sell-off in the broader commodity complex. So that's going to remain key is what happens in the outside markets. Very frustrating, though, to those farmers in those regions. Next question, Jake.
Next question comes from Scott. When you state cash prices in your slides, how do those compare to the nearby future prices for each crop, i.e., what basis levels are you using?
Well, that gets a little bit tricky, Scott, because as the way we are structured under Dodd-Frank, I cannot do anything which would forecast futures prices. That structuring allows us to be on the trading floor with the brokers, have access to more information and more interaction, and helps us do better analysis overall. But this is where it handicaps us. So unfortunately, I can't answer that question on tying it to futures. I could only talk about historically what similar dynamics would play out in marketing your average cash prices and allow you to look those numbers up and make your own assumptions. Next question.
The next question, why was market reaction muted? Did the market already expect it? What were the major factors caused the expectation?
Yeah, I think the market reaction was largely muted because even though we saw some buying in the broader commodity sector today, overall there's a lack of belief that that can really sustain itself. It may, but maybe it's better said, everyone's being very cautious about buying into the commodity sector right now. So there's a wariness. And since these fundamentals weren't outright bullish, it meant that it was safe to kind of wait and see how things play out with the outside markets. There was no rush to jump in there. because the crop was half of expectations or anything like that. So I think that spoke volumes about the cautiousness of this market, even though the VIX, which is Wall Street's fear index, trading at its lowest level since 1993, it's a much different picture in the commodities than what it is in the stocks.
Next question comes from Eduardo. You mentioned that the USDA is normally overestimating soy ending crops from May WASDE versus the end of the season number. How about corn? Do they overestimate as well, May versus end of season?
Good question. I should have brought that up earlier. Exactly right. With corn, it's about 50%. It's a 50-50 thing. About half the time, they overstate, half the time they understate. There's no real clear trends in corn, which says they're probably doing a pretty good job if they're wrong on either side about equal number of times and within a relatively narrow margin, so to speak. So they're probably doing a pretty good job. It's just soybeans where they have that strong tendency. Excellent question.
Next question comes from Andrew. Are you currently projecting any changes to corn/soybean acres from its current estimates?
Changes in acreage from the USDA's March 31. At one point, I was looking for an increase up to the 91.6 million acres of corn, up about 1.6 million from USDA's current estimate. As I indicated, I'm backing away from that now as I see today's forecast and the progress. I do still think that we can hit the 90 million. Although we're becoming increasingly vulnerable to maybe slipping closer to the 89.5 million if things turn out wet and we're not able to get the replanting that we need to get done in addition to some of the planting. Areas most at risk would be kind of the southwestern part of the Midwest. That's where the risks are the greatest. On the soybeans, I still think that maybe we're a little bit at risk of declining acres. I just said corn may drop a little bit, but my biggest concern is if these soybean prices break lower once again, how many double crop acres will we get? And that's a concern. Now, with good moisture, in a lot of areas, particularly in the plains, you have good moisture, you can cut out soybeans at a very low cost, so to speak. But I do think that USDA was fairly aggressive in its initial planting estimate anyway with soybeans, and so that does leave us a little vulnerable, losing a few acres there as well.
Thanks, Alan. Francisco asked another question. I see meat futures soaring, cattle, hogs, and feeder cattle. Does that impact soybeans somehow? Very indirectly, if at all, on the soybean price. In meat prices, it's been more of a situation of first of all, separating the beef from the pork, of a near-term shortage in supply where demand ended up being higher than expected. Feeders were worried about seasonally lower prices, so they kept pulling cattle forward. All of a sudden, we realized we were very green on cattle. We were very current. At the end of April, for example, we were slaughtering cattle that would be expected to be coming in June. Feeders suddenly realized they were in control. Same time, we have this winter storm moved through the feedlot district. Cattle, we had some death loss, plus we had a lot of cattle lost finish, and so the feeders wanted to keep them for a little longer to put some finish back on them so they would grade better in the packing plant. And so they held those cattle back, and all of a sudden then we had a short-term really tight supply and caused the cash market to really spike. We're also seeing export demand stronger than what is expected. So that's been the primary driver of a lot of speculative money driving it, but there's been some good fundamentals underneath of it. Pork has also seen much stronger exports than what was anticipated. Production's come in pretty close to expectations, but exports and domestic demand has been pretty strong. That's been helping support the price. The cash market trending lower right now at a time when the supplies tend to seasonally decline a little bit. But not a lot of direct impact on price, maybe some impact on the fundamentals of soybeans, but more of an impact on corn. Jason has a question. Any thoughts on bean oil?
It's good for cooking, but I take it you're probably looking for something more fundamental. I think the big question on soybean oil is the trade's perceptions of this international trade investigation on whether Argentina and Indonesia are unfairly dumping biodiesel here in the United States. When you look at the big picture, I think if they would get a favorable trade ruling on that, probably later this year, excuse me, if we'd get a favorable rating, that could cause a real spike initially in demand. But we are net importers of soy oil, and that means we export, but we import more. And so suddenly the higher price would mean we'd hold back more of those exports, which means customers don't get service, so they buy from somewhere else. But we're importing less, but since we're the biodiesel, we're importing less biodiesel, so we need more. And so when it's all said and done, from a global standpoint, it doesn't change matters any. We just reshuffled who's shipping soy oil and who's shipping biodiesel. Now, global stocks of soy oil are the tightest that they've been really in modern history, around 7% of usage. But the debate, and I think fairly so, is does that matter? Because if you start running out of soybean oil, the price goes up and that improves crush margins, which incentivizes crushing more soybeans, which increases the supply of oil once again. And since we're not in danger of running out of soybeans to crush, I'm not sure it really matters. If soybean stocks were very, very tight, like we saw a couple of years back, then those tight global supplies of soy oil would really matter a whole lot more. But since soybeans could quickly be brought in and crushed, it really doesn't matter. I hope that's answered your question.
We have another question from Francisco. Are speculators net short in grains? If so, by how much compared to recent history?
In Chicago wheat, it's been a record, around 900 million bushels. So what we're at 3 times the size of the actual crop. That's net short. On soybeans, it's a relatively modest net short position. On corn, it's approaching record short positions. I think the record is a little over 1.2 billion bushels short of, I'm talking hedge fund positions here. We're getting close to that number, not quite there. So corn and wheat, it's very significant. Soybeans, it just depends, don't like being short soybeans. Historically, they don't like, and they tend to not stay short for very long. But we may have a shifting paradigm there, so stay tuned. Next question, Jake.
Looks like that's all we have, Arlan.
Excellent. Well, I'd just like to thank everybody for their participation today. I really enjoy these, and we'll be back again in June for the June crop report. And feel free to tell your friends about it and coworkers. They can get back on and watch this again. And, you know, this is successful because of you, the listeners, and for participating and for asking the questions. So thank you very much, and we'll see you next month.